Did you know that George Soros once made $1 billion in a single day? It's true. In 1992, Soros bet against the British pound and won big. But that's just one example of his genius. Soros's book, The Alchemy of Finance, is packed with investment wisdom that many people overlook. In this video, we're diving deep into Soros's world. We'll explore 12 investment gems from his book. You'll learn how Soros turns market chaos into profit, embraces uncertainty, and masters market psychology. Ever heard of reflexivity? It's a game-changing concept Soros uses to understand market dynamics. We'll break it down and show you how to use it in your investments. Plus, we'll reveal Soros's secret to anticipating market shifts and transforming perceptions into profits. Stick around, because by the end of this video, you'll see the market through Soros's eyes. Get ready to unlock the secrets of one of the greatest investors of all time. One navigating the Soros code, the art of reflexivity. Have you ever wondered how markets really work? George Soros, in his book, The Alchemy of Finance, introduces us to the concept of reflexivity. It's a fancy word, but the idea is simple. Reflexivity means that investors' perceptions shape market reality, and market reality, in turn, shapes investors' perceptions. It's a loop. Soros uses the example of the real estate bubble to explain reflexivity. When people think real estate prices will go up, they buy more property. This increased demand pushes prices higher, confirming their initial belief. It's a self-fulfilling prophecy. In 1992, Soros famously bet against the British pound. He observed that market participants believed the pound was overvalued and acted on it. His understanding of reflexivity helped him predict the outcome. He made $1 billion from this bet. The reflexivity theory isn't just for big shots like Soros. You can use it too. Next time you invest, consider how market perceptions might influence prices. It's like being a detective in the financial world, piecing together clues from market sentiment. To the quantum leap. Embracing uncertainty in investing. Embracing uncertainty might sound scary, but Soros teaches us that it's essential. Markets are unpredictable. Accepting this can make you a better investor. Soros says, "I'm only rich because I know when I'm wrong." This humility allows him to adapt. Soros's quantum fund, which he founded in 1973, is a testament to embracing uncertainty. The fund delivered an average annual return of 30% over 4 decades. That's incredible, right? One key to this success is being flexible and open to change. Data from the CFA Institute shows that overconfident investors tend to underperform. Embracing uncertainty means being ready to change your mind when new information comes in. It's about staying nimble. Think of investing like sailing. You can't control the wind, but you can adjust your sails. Soros adjusts his sails by constantly reassessing his positions. This keeps him ahead of the game. Try it next time you're unsure about a stock. Stay flexible, and don't be afraid to change course. 3. Beyond the horizon. The fallibility of human judgment. We all make mistakes. Soros acknowledges this and uses it to his advantage. He calls it the theory of fallibility. This theory states that our understanding of the world is inherently flawed. So, how can you turn this flaw into a strength? First, recognize your biases. Soros is aware of his and constantly questions his assumptions. A study by Dalbar shows that the average investor earns significantly less than market indices due to poor decisions driven by biases. Soros's success during the 1987 market crash is a prime example. While many panicked, Soros saw an opportunity. He understood that human judgment was clouded by fear. By staying calm and rational, he profited while others lost. To apply this, start by questioning your investment decisions. Are they based on facts or emotions? Soros suggests writing down your investment thesis. This helps you stay objective and spot errors in your thinking. 4. The butterfly effect in markets. Small causes, big consequences. Soros's theory of reflexivity aligns closely with the butterfly effect in chaos theory. Small actions can lead to significant consequences. In finance, this means small market movements can trigger big changes. Take the 2008 financial crisis, for example. It started with a small sector, subprime mortgages. But the impact rippled through the global economy. Soros's funds were prepared for this. He had anticipated the housing bubble and adjusted his portfolio accordingly. A report from the Federal Reserve highlights how interconnected markets are. Understanding these connections can give you an edge. Soros uses this knowledge to foresee market trends. He looks for small signals that might indicate larger shifts. You can do the same. Pay attention to small changes in the market. These might be early warnings of bigger trends. Soros often says, it's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong. Keep an eye on the details, and you might spot the next big market move. 5. From chaos to clarity. Making sense of market trends. Making sense of market trends can feel like navigating a maze. George Soros has a knack for finding clarity in chaos. He uses his theory of reflexivity to decipher trends. By understanding how perceptions influence reality, he can anticipate changes. Soros's investment in the Asian financial crisis of 1997 is a great example. While others were lost in the chaos, Soros saw a pattern. He predicted the devaluation of the Thai baht and positioned himself to profit. This move earned him and his fund significant returns. A study by the Journal of Finance found that investors who follow market trends tend to outperform those who don't. Soros's success supports this finding. He looks for patterns in market behavior and uses them to his advantage. To apply this, start by observing market trends. Look for repeating patterns and consider how investor perceptions might be driving them. Soros often says, markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected. Keep this in mind as you navigate the market maze. 6. The double-edged sword. Risk and opportunity in reflexive markets. Risk and opportunity are two sides of the same coin. Soros understands this better than most. He sees risk not as something to avoid but as a source of potential profit. His approach to reflexive markets involves balancing these two elements. In 1992, Soros took a huge risk by betting against the British pound. This move, known as Black Wednesday, was risky, but Soros saw the opportunity. He believed the pound was overvalued and that the UK would have to withdraw from the European exchange rate mechanism. His calculated risk paid off, earning him over $1 billion. According to research by Risk.net, investors who take calculated risks tend to achieve higher returns. Soros's strategy exemplifies this. He carefully assesses the risks and weighs them against potential rewards. To adopt this strategy, start by evaluating the risks and opportunities in your investments. Don't shy away from risks, but don't take them blindly either. Soros advises, the worse a situation becomes, the less it takes to turn it around, and the bigger the upside. Use this mindset to find the balance between risk and reward. 7. The Soros Playbook. Learning from history's financial crises. History is a great teacher, and Soros has learned well from it. He studies past financial crises to prepare for future ones. By understanding what happened before, he can anticipate what might happen again. Soros's analysis of the 1987 market crash is a perfect example. He recognized patterns from previous crises and used them to inform his strategy. While others panicked, Soros remained calm and made profitable moves. Data from the National Bureau of Economic Research shows that financial crises follow certain patterns. Soros uses this knowledge to stay ahead. He looks for signs of potential crises and prepares accordingly. You can do the same. Study past market crashes and learn from them. Look for patterns and consider how they might apply to current markets. Soros often says, misconceptions play a major role in determining the course of history. Use this insight to spot opportunities and avoid pitfalls. 8. Alchemy of Value. Transforming perception into profit. Transforming perception into profit is a skill Soros has mastered. He understands that market perceptions can create value. By anticipating changes in perception, he can capitalize on them. Soros's investment in gold during the 2011 price surge is a great example. He anticipated that fear of economic instability would drive up gold prices. He bought gold early and sold at the peak, making a substantial profit. Research by the World Gold Council shows that investor perception heavily influences gold prices. Soros's success with gold reflects this. He identified a shift in perception and acted on it. To use this strategy, start by paying attention to market sentiment. Look for shifts in perception that could impact prices. Soros advises, an investment is only risky if you don't understand it. Understand the perceptions driving the market and use them to your advantage. 9. The power of bet size. Risk management in Soros's strategy. Bet size matters. Soros knows this well. He doesn't just focus on what to invest in, but also on how much to invest. This strategy is crucial for managing risk and maximizing returns. Take Soros's bet against the British pound in 1992. He didn't just predict the pound would fall, he placed a huge bet. By allocating significant capital, he maximized his gains when the pound crashed. This move, known as Black Wednesday, netted him over $1 billion. A study by the CFA Institute shows that position sizing is key to risk management. Soros's success highlights this. He balances his investments carefully, considering both potential returns and risks. To apply this strategy, start by assessing the size of your investments. Don't just think about what to invest in, but also how much. Soros often says, it's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong. Keep this in mind to manage your risks effectively. 10. Mastering the market's mind. The psychology of trading with Soros. Understanding market psychology is a game changer. Soros excels at this. He knows that markets are driven by human emotions and behaviors. By understanding these, he can predict market movements. During the tech bubble of the late 1990s, Soros saw how euphoria was driving prices up. He knew it couldn't last. By understanding the psychology of the market, he avoided the crash that followed. Research from the Journal of Behavioral Finance shows that investor psychology plays a huge role in market dynamics. Soros leverages this. He looks beyond numbers to understand what drives market behavior. To use this strategy, start by studying market psychology. Pay attention to how emotions like fear and greed influence prices. Soros advises, the market is a reflection of the mass psychology of investors. Use this insight to anticipate market trends and make informed decisions. 11. Soros's secret sauce, the art of anticipating market shifts. Anticipating market shifts is an art, and Soros is a master artist. He uses a combination of analysis and intuition to predict changes. This helps him stay ahead of the curve. Soros's bet on the collapse of the housing market in 2007 is a prime example. He saw the signs of an impending crash and acted early. This foresight saved his fund from significant losses and allowed him to profit from the downturn. Data from the Federal Reserve highlights the importance of anticipating market shifts. Investors who can do this tend to outperform others. Soros's success underscores this point. To adopt this strategy, start by honing your analytical skills. Combine this with intuition and experience to anticipate changes. Soros often says, the worse a situation becomes, the less it takes to turn it around, and the bigger the upside. Use this mindset to stay ahead of market shifts. 12. Beyond the alchemy. Applying Soros's wisdom to modern investments. Soros's wisdom is timeless. Even in today's fast-paced markets, his strategies are relevant. By understanding and applying his insights, you can enhance your investment approach. In 2020, during the COVID-19 pandemic, markets were volatile. Investors who applied Soros's principles, like flexibility and understanding market psychology, fared better. They adapted quickly to changing conditions. A report by McKinsey & Company shows that adaptable investors tend to succeed. Soros's strategies are all about adaptation. He constantly reassesses his positions and stays flexible. To use this in your investments, start by embracing change. Be willing to adapt and reassess your strategies regularly. Soros advises, the financial markets generally are unpredictable, so that one has to have different scenarios. Keep this in mind to navigate modern markets successfully.